Welcome to Barometer Reading. Sorry for the technical difficulties. My name is Diana Avigdor, and I'm the head of trading at Barometer Capital. Some of you know me, and for those of us, for you that do not, I am trading since 1995, and I started in FX and then moved on to equities at Altamira Management, a private mutual fund company that is now owned by Natcan. Throughout the years, I have gone through ups and downs in the market, and my role is not the same as the portfolio managers and analysts. What I do is I check the market temperature on a daily basis. I look at it in a much more granular manner, and then test the patient for whether he's feeling good or not, see what's priced in and what isn't, and how the market reacting. How the market reacts to things is very, very important in determining the health of the market. And some of my tools include economic data, earnings, and how the stocks react to the earnings, and how the market absorbs news. Like I said, how the market absorbs news is very important in determining the health of the market. So in this webcast, we're going to go through some of the things that we're seeing in terms of trends, economic data, and how the market's reacting to it, what worries the market, and what kind of things that needs to go through earnings, and how our portfolios fit into all of this. So without further ado, let's just start. We'll start from top down, and our top down sentiment and premise is that we are in the structural bull market, which tend to last on average about 14 years. We're about halfway through, and this is a basic premise of ours, which allows us to stay invested in the market, just thinking that the market is experiencing an upswing, which does tend to last a little bit longer than the short term. Another premise of our basic long-term view is that we have seen generational lows in rates. Right now, we've had central banks that have been very accommodative and have thrown a lot of money at the market. But now we're going to start seeing a little bit of normalization, and normalization is good, not bad. But to that end, we're going to go from zero rates to maybe something more normalized. And so we've seen generational lows in rates, which makes us less wanting to invest in fixed income assets or fixed income equities. Another premise that we have seen, and this is a more recent one, when we compare data to previous times, we think that we are in the beginning of a commodity cycle. I'm not saying super cycle at this point, but cycle nevertheless, probably driven by demand coming out of COVID and some underinvestment in the sector. It's been at least a decade before this has come back to where it used to be. So there has been some underinvestment in the sector for sure, and some demand-driven investments are probably not a bad idea at this point. Looking at the S&P, this is about a year and a half, just over August, September, we have seen this sell-off after a full year of pretty decent returns where people might have gotten a little bit comfortable that never going to see another sell-off again. But it actually has been quite rotational, and it was not a bad thing because it climbed walls of worry, as where you can see my cursor, and has taken out the sell-off and is now currently making new highs, despite all kinds of headlines, which we'll go through at the end as to what might worry the market. This is the market pricing in things, whether it's anxiety ahead of earnings or taper or Evergrande or all kinds of headlines that we may have seen. At the same time, volatility as measured by the range in the market has steadily gone down. This is also a measure of fear, and it has hit its high at the time that the market has been making this low, and then it has normalized as well, allowing us to confirm this take back and the subsequent new high. And our indicators, which are proprietary, and we do this work every day, have become consistently more bullish. Percentage of stock with weekly momentum, high-low index, percentage above 30-week moving average. Those are some of them, have gotten progressively better. Despite the fact that sentiment is, I would categorize it as a 5 out of 10. Not everybody is very confident in the market. There is just so many headlines, and yet the markets are moving higher. So why does that happen? The average S&P 500 return from 1950 to current tends to have a seasonality at the fourth quarter, which begins actually this month. And this is kind of what it looks like if you were to put it on a graph. It really does take off in the fourth quarter. There are some reasons to it, which at the gut level are very reasonable. And I will mention them in a minute, but I just want to show you this chart. November to April return on average is about 7% relative to the May to October, which is really the lowest. So it's almost 3 times as much return from the seasonality. And this is a chart that has been taken from 1950 to the present. Some of the reasons, and I'm not going to go into too much of a detail on this, but some of the reasons at the gut level you might think is we have a Christmas season that brings on spending. There's something we call the budget flush. Those are companies and even governments that tend to want to spend the budget that they have been given for the particular year, because if they do not, they will not get the same budget or more in the next year. So there is a lot of spend going on in the fourth quarter of a year, which kind of brings on seasonality. And then the first quarter, it's a new year, there's lots of money coming in. Here in Canada, there's a lot of RSP money, and in the US also, their equivalent of the retirement money that does come into the market tends to buoy the investments and flows into the market. So what have we seen in the last few weeks? In the last few weeks, we have seen a steady betterment in the mid-cap stocks, as well as the small-cap stocks, a series of X's, which in the point figure charts shows a better and better environment. So something has been going on to the small caps and the mid caps relative to the large caps in the market. Small caps tend to be a more risk-on feeling, and also points to more better domestic. Something is happening domestically for these companies to start doing better. It is also seasonal. It also has seasonality. This is the Russell 2000, which is an index of small caps. And it has been consolidating for a very long time. All the while we've been hearing the S&P and the Dow and the NASDAQ making new highs every day. Small caps are inching closer to, and finally, this is what happened yesterday. We had a big candle up and we have broken out. Yesterday, the Russell was up 2.7%, almost 200 beeps higher than the other indices, the larger caps, the S&P, the Dow, and the NASDAQ 100. So what's happening? What's happening is an increase and a widening of breadth. This is the S&P Completion Index, which is all the non-S&P 500 issues. You may have heard in the headlines that only a handful of stocks have done really well. Amazon and the FANGs, Facebook, Apple. But now what we're seeing is that the other companies are doing much, much better after a period of consolidation. Now, I would say from a technical perspective, which is what we traders do look at, the longer the consolidation, the higher the upside measurement once it finally does break out. This also is seasonally. Small caps do tend to outperform. And this is just another chart of this consolidation on the all stocks, the non-S&P stocks that are finally breaking out. So now there is more stocks participating than before. This is historical Russell 2000. This is the small cap that I've mentioned. Small caps do tend to have seasonality as well, and they tend to outperform in the fourth quarter and all the way through spring. This is the first 90 days of the year, and this is the last 90 days of the year. So we're expecting, if this chart, if this trend is an indication, we're expecting this to likely be able to go ahead. So what happened this week, this week's data? We've had earnings, lots of earnings, it's earnings season, and expectations were really high. However, The sales growth on all securities has been nice, 17.5%. Earnings growth has been even better, 38%. Great margins. Materials, industrials, energy has had a very nice earnings result. These are sectors that we are overweight in. We are underweight utilities and healthcare, and they've been expectedly a little lower. Now, the comps from last year, which the growth is measured from, has been pretty difficult. In other words, there have been good earnings last year as well. So when we compare, the sales surprise being positive is great because they run across difficult comps, and to beat those is even better. So the sales surprise was 2% and the earnings surprise is 9%. What we mean by surprise is we have expectations, the expectations are already high, and then they beat those high expectations. So that the earnings season has been great. The percentage of S&P 500 companies beating earnings estimates been 83%, a little lower than previous because we've come out of COVID and companies have done pretty well, but it's still very, very high. So earnings are good. What else is going on? Economic data. This is the Citi Economic Surprise Index. And what it measures is economic surprises. It doesn't mean that the economy or the economic numbers are necessarily bad. It just measures the difference between the expectations and what it has come out. So maybe expectations have gotten a little lofty, but the economic data has come a little lower than expected. And why would expectations be a little lofty? Just because we're coming out of COVID, the economies are coming out, are opening up, people want to go out, and maybe there was overestimation of what the demand was going to be. Economic data has come in not bad, except on the job side, but PMIs and all kinds of other metrics have come in better than expected, however, not better to the expectations until very recently. Now they've started beating, they're still a little negative, but they're doing relative to expectations a little better. The economy, it looks to be opening up and looks to be doing quite well. We still have some laggard on the job side, but otherwise we have a pretty decent economy. Moving forward, in terms of the economic situation, this is the dry bulk ship index. We talk about supply chain bottlenecks, and a box of cargo has gone up in price multiple fold. As the economy reopened, there was demand. Some companies were not ready for the shipments, the amount of shipments. And you know, we've heard this on semiconductor side as well, that there was a shortage of chips and how it played into the auto market, that there wasn't enough chips to build the new cars that were expected. And so the used car market has really rallied up. But that is now moderating and prices are coming down and these bottlenecks are being worked through. So we don't know yet, but certainly seems to be transitory. The supply and demand balances out a little bit better over time. Another thing is we have Christmas season coming up. Now, retail sales usually go up 2%, 4%, 5%. Since COVID, we've had an 8% growth. And now the National Retail Federation is forecasting between 8.5% and 10.5% growth for the Christmas season in terms of sales in retail. That is very good demand. And if we were to look at some of the retailers, they've actually done very well. So the consumer is spending, the economy is growing, and we don't want it to grow too fast because we think we're in a reflation period and we don't want to get to inflation. So reflation is good. In terms of flows, this is, as a trader, I watch this a lot. there's been 2021 has been a fantastic year for flows. And some of the reasons that you might think is, people staying home save a lot of money. They've gotten checks from the government. We hear that at least 30% of that is still in savings. People were worried about markets, so they moved some money out of the markets back in 2020, and some of that is coming back in. There's $4.5 trillion of cash on the sidelines, plus very accommodative governments and very accommodative central banks. We also have share buybacks. Share buybacks are incredible. It's incredible because this works to support the market. So, this is a tax efficient way for companies to return capital to their shareholders, and as well as massive flow support into the market. Apple has a $90 billion authorization, Microsoft 60 billion, Google 50 billion, Facebook 50 billion, and I can go on and on and on. Citigroup invested $46 billion in repurchases in the last 3 years and took down their share count by 20%, a little more, 22% to be exact. So this continues. Authorizations and buybacks continue, and that is supportive of the market. So this is another reason why we like equities. But we're a tactical manager, so we will always look for leadership without bias. We will recognize change and adjust, and we have no problem to turn around and play defense should something turn around and not be right. So what are the leadership themes right now? So we've talked about small cap and mid cap relative to large cap. This is our portfolio. 65% of our portfolio is in large cap relative to 35% or so in small and mid cap. So that is a decent exposure from a full portfolio perspective to this sector that we think is poised to do well. In terms of some of the trends that we're seeing, we like energy, and this is a chart of what the energy ETF has done in Canada. My role as a trader doesn't go through, I don't look at the particular stocks, so I've invited Amit Joshi, Associate Portfolio Manager, and James Callahan, analyst on the US side, to join me to discuss some of our holdings going forward. So energy, I mentioned we like, as a trend that has had relative strength. And one of our stocks that we have in our portfolio is a small cap called Tamarack Valley Energy. Amit, Tamarack Valley Energy. I don't know it too well. Can you tell us a little bit about it, because it has done very well for us?
Definitely. Thanks so much for having me, Diana. So Tamarack Valley is a small cap, multi-asset oil producer with growth assets focusing on the Clearwater and Charlie Lake plays. It has a market cap of about 1.5 billion, and the company just reported a really strong third quarter earnings result. They beat on average daily production by 7% compared to consensus analyst estimates, and they also beat revenue by 6% on consensus estimates as well. The cash flow per share was very, very strong, beating consensus analyst estimates by 5% as well. So just a very strong earnings result by the company itself.
That's great. We talk a lot about dividends and capital return. I've just talked about buybacks and how that's a capital return to shareholders seems to be something that investors do need in the low rate environment, particularly from their equity exposure, at least. Is there any capital return conversation around some small caps, or do they not do that?
Yeah, no, that's a great point, Diana. And it's very interesting. In the past, what we've seen from oil and gas companies has kind of been to reinvest free cash flow into production growth. And in this cycle, we've seen a bit of a change in the tide in terms of moderate production growth, but more significant shareholder returns in the forms of capital being returned to shareholders in the form of dividends and share buybacks. So not only did Tamarack Valley post a great earnings result, but they also released their capital plans as well and initiated a monthly base dividend that equates to about 2.8% annual yield, which will start paying in January of 2022. And given the strong free cash flow that Tamarack is currently experiencing in the strong commodity prices, they unveiled the base dividend, but also have a longer term return of capital strategy once they've paid down their debt to their target level. So currently the debt sits at about $500 million. They're targeting about 250 to 300 million in the longer term. And once they're at this point, they'll look at returning about 50% of the previous year's free fund flows in the form of the base dividend, as well as tactical share buybacks and special dividends. So, the amount of capital that will be returned by even a small cap energy company like Tamarack Valley is very substantial. The dividend initiation, as well as the current market cap, could make Tamarack a likely candidate for inclusion in the S&P TSX Composite Index, as well as other energy indices as well. So definitely plays on that theme of returning capital to shareholders, and the strength that we've seen in oil and gas and the energy sector plays really well to the reflationary theme that you talked about before.
Right. I love that. I love that you don't have to invest in the small cap. That's just a story without earnings, that you're able to get paid while you're waiting for it to move on to become a mid cap, or to your point, goes into an index, which will allow it some more money to follow the stock. That's great. One of the other things, we talk about energy, and that's fine, but this is a chart of the full commodity, all kinds of commodities in there. And there are all kinds of commodities out there. And immediately we think about energy, oil and gas and copper and aluminum, but there are some more obscure commodities which do play into our modern society. And you and I spoke about this once before, NanoExplore. And NanoExplore is exposed to something that not too many of us heard about it a few years ago, but it kind of disappeared off the radar, and it's graphene. What is this, Amit?
Yeah, great question. So NanoExplore is a manufacturer and supplier of graphene powder. And graphene, like you said, is probably a material that's a little less familiar to investors. So very simplistically, graphene is a material that's derived from exfoliating graphite. And what makes graphene really interesting is, as a material, graphene is the lightest, strongest, thinnest, has the best heat and electricity conducting material that's found to date. So much so that the two scientists that discovered graphene won the 2010 Nobel Peace Prize in Physics. So it's a very interesting material. A lot of kind of, like you said, in terms of a story aspect to it, of the use cases itself. And the reason we kind of heard about it earlier on, probably in 2010, and we haven't heard much about it after that, is historically graphene has been very difficult to scale and scale production in a cost-effective manner. So this plays well to NanoExplore. They're a small cap company, market cap about 1.2 billion, and they're a manufacturer and supplier of graphene powder, like I said. The company
Why
itself
now,
has
Amit? Why now? Why now? I see the chart has just taken off. Why now?
Yeah, so the company itself has a patent manufacturing process by which they use liquid exfoliation, and this provides them the ability to process graphene at a low cost, highly scalable process, and they can do this in large volumes. It's also environmentally friendly and sustainable. So NanoExplore's current facility in Montreal produces about 4,000 metric tons of graphene powder annually, and that would make them the largest producer in the world. So like I said, there's very few end use cases for graphene since it's been a harder material to produce. But NanoExplore has been working with their customers to develop some of these end markets and using graphene as a performance enhancing product, so in plastics and plastic components itself. So what's interesting about the company is they have the ability to increase production from 4,000 metric tons currently to about 16,000 metric tons by 2023. The company also has a strategic shareholder in a Canadian auto parts company called Martinrea, and Martinrea holds about 22% of the shares outstanding. Mm-hmm. So NanoExplore creates graphene products for Martinrea, in which they use graphene in their brake lines, which will strengthen the casing and thus bring down the costs and increase the durability at the same time. And then earlier this year, Martinrea and NanoExplore announced a joint venture called VoltaExplore. And what they'll look to do is further battery-based initiatives in electric vehicles and grid storage market. So they'll start this by building out a demonstration facility to develop and produce EV batteries that are enhanced by graphene. So very interesting kind of catalyst there as we see more expansion in electric vehicles and just the demand and tailwinds in electric vehicles themselves. This becomes a pretty interesting company to have in our portfolios and watch, and still in the very early innings of growth.
Great vertical, electric battery, electric EV, batteries for EV. That's certainly a growth sector. Okay, thanks, Amit. Going forward, actually, there is, we hear a lot about crypto and crypto mining and the volatility around cryptocurrencies and the whole philosophical argument about whether it's going to replace the monetary system or not. But there are companies that feed into this that you don't necessarily have to take quite the volatility, the existential volatility of cryptocurrency. And this is Hut 8 Mining that you mentioned to me, saying that this is quite interesting and we have a holding and it's done fantastically well.
Yeah, really interesting company, Diana. And Hut 8 Mining is a cryptocurrency miner, and they offer blockchain infrastructure and technology solutions. The company has a market cap of about 3.1 billion, so slightly larger than the other two companies that we just spoke about. And they have about 100 megawatt production, which makes them about one of North America's largest Bitcoin miners. So this is very much a second derivative trade to investing directly in cryptocurrencies or in Bitcoins itself. And we've been seeing some favorable backdrop in the cryptocurrency industry itself. One kind of industry-wise, we've seen the Chinese government cracking down on cryptocurrency mining throughout the summer, which has created a more profitable backdrop for the North American crypto miners. And how this has impacted Hut 8 is the ability to exploit the supply chain and procure equipment at faster and better prices. So the company is actually bringing on more mining equipment and will be bringing on a third facility in Alberta with this new equipment itself, and have access to 100 megawatts of power at a price that's materially lower than the current pricing that they're using at the other sites. So just the kind of the backdrop with strong cryptocurrency pricing in Bitcoin, as well as them being able to procure equipment at better costs, has been quite the catalyst to expand EBITDA margins. The company also holds Bitcoin on their balance sheet itself. They own about 4,550 Bitcoins, and they've begun an initiative where they're generating income from the Bitcoin that they hold on their balance sheet by lending this out at attractive interest rates. So kind of a second line of income that the company is generating. So just a very interesting niche idea in the crypto mining space.
So it is a bit of a second tail to the volatility just from the portion of the Bitcoins that it holds.
Yeah, I think being a crypto miner and holding cryptocurrencies on your balance sheet, you're not going to escape the volatility of the underlying cryptocurrencies themselves. So it is, when we look at a position like this, it's sized in a conservative manner, but we do have the ability to get exposure to cryptocurrency through Hut 8 Mining, and it's something we watch closely. But the current backdrop is very interesting. And like I mentioned, will drive significant EBITDA margins for the company.
Really interesting companies that you're describing in this 35% weight of small cap, mid cap that we have. I love it. Going forward, thanks, Amit. One of the other trends that we have been seeing is, of course, the semiconductor. We've mentioned semiconductor businesses before. On the large cap, first of all, I would just mention that semiconductors, why people look at it, is certainly because it is the most cyclical nature of technology. And, as the economy grows, you need more semiconductors, and so it tends to be the more cyclical side. And we can see here how it's a good look at the cyclicality. Semis have broken out versus software. And our portfolios are pretty cyclically tilted as the economy reopens. So, we've spoken before on the semiconductor side about large caps that tend to dominate the sector, Intel, NVIDIA, ARM, and AMD, not ARM, sorry, AMD. But we do have exposure to some of the smaller cap Semiconductors, and one is SciTime Corporation, one of James's favorite. His picture there says David Burrows, but it's James Callahan. James, can you talk to us a little bit about the semiconductor exposure and specifically SciTime, which also has a fantastic chart?
Yeah, absolutely. Thank you, Diana. And as you said, it is one of my favorites. It's been a favorite for some time now. I guess just with this company, to set the stage, I think it's important to just have some industry context. It's ancient history for semi companies now, but back in the day before they could outsource fabrication, they had to build their own fabrication facilities and make their own chips. Now the dynamics of the market are such that as a semi company, you can and you most of the time should design your chips and then go talk to Taiwan Semi, which is the global leader in semi fabrication, to get your product built. So this has become a pretty common business model in the industry, and companies that do this are called fabless semis, because they do the design, they own all the IP, but they outsource the production. So when you're looking at the fabless semi industry, where we want to focus is on the companies with differentiated technology that can't be easily replicated. Because once some other company can build a competing product, they can also go to Taiwan Semi and have it built as well. So our fabless semi investments are all concentrated on companies with differentiated technology. NVIDIA definitely falls into this camp, as does Lattice Semi, which is another mid-cap fabless semi that we own. But SciTime is definitely one of the best examples of what we would look for in a fabless semi. So we first bought the stock in July of 2020, and it's worked really well since, as you can see from the chart.
Very nice.
So to quickly explain the tech, SciTime makes something called a timing chip. So a timing chip inside of a processor makes sure that all the components of the processor are running at the right speed. So that's called the clock rate. The way that this is usually achieved is through running an electric current through a quartz crystal. The electricity takes a certain amount of time to pass through the crystal, and then other components of the processor use that time as a reference point. So processors are getting smaller and smaller, as we know, and quartz crystals can only get so small. And we've reached the point now where for specific applications, we need timing chips to be smaller than quartz can be and to be able to handle more extreme environments as well. So SciTime figured out a way to make timing chips out of silicon, so they can be much smaller than quartz. They run on less power. They can handle extreme forces and extreme heat and cold without compromising performance, whereas quartz can't. So SciTime claims versus quartz, their silicon-based timing chips deliver 30 times better performance, 80 times smaller size, and 20 times better reliability. So those numbers speak for themselves. And I should mention as well, there's only one other company that's been able to move past quartz timing chips to silicon. They're still a few years behind SciTime. They're a lot bigger, and they've made it clear that it's not really an area where they want to invest further, because they have some other areas they want to focus on. So for now, SciTime's the standout leader. So we like them a lot, and they've worked well in portfolios so far. So I hope that wasn't too technical, but that's SciTime. And maybe Diana, just in the interest of time, I know I was going to speak about another company, but I think we're going a bit long. So the good thing about investing in small caps is that, hopefully they turn into mid caps, and from there, hopefully they turn into large caps. So maybe we can come back to Veritone when we're talking about large caps someday.
Yeah, no problem. This is the chart of robo and artificial intelligence, which we also have exposure of, and Veritone is one of our holdings, which we will mention going forward. Certainly part of the robotics and artificial intelligence space. Thank you, James.
Thank you.
One of the other things that we are seeing, of course, and we love this, is that Canada is breaking out from a 15-year period of inconsistency, and this is good for us because investing in the home means that we don't have to have foreign exchange exposure or other things like that are global nature. One of the reasons that Canada is outperforming and finally breaking out is because it has an overweight in all the sectors that are working, like financials, energy, industrials, and materials. And 20 years ago, it barely had any tech. Now it has some tech. So to the extent that all of these sectors are working, we love these sectors. These are our overweights. And so Canada is great. Our portfolios are 65% Canada versus 35% US. This is good for us in Canada. For those clients that have exposure more in Canada and less US, that means that they don't have again, FX risk. In some cases, we're able to hedge them back. In some cases, the mandate doesn't allow for it. But investing in the home is always less risk from a global perspective. Financials is our own underweight. We haven't changed our portfolios much over the last little while, but we are overweight financials. It gives us dividends and growth and capital return and buybacks and exposure to the economy. Somebody asked about the yield curve and the flattening of it. Yes, it ahead of a taper, the short end has kind of moved up. We think that it's possible that it has priced in a little bit of too much taper or too fast of a taper. Every time there is some inflation expectations, that tends to be the case. It's possible that it'll steepen up a bit. Either way, there is exposure to the real estate market and so forth. The financials have done very well. Information technology, we have 20%. It's a little underweight from what it is in the US index, but not Canada, of course. We have 11-12% energy, which hasn't changed for a while, but it does have a beta. So to the market tends to move about 2 times the regular index. There are always going to be concerns, and these have been concerns that we put up before. Delta variant, sure, seems to be working through it. Evergrande, we heard about it more 2-3 weeks ago. They've now paid a few coupons. So that seems to be a little in the background right now. Supply chain disruptions, some of the pricing on the container bulk side has come down. So we're working through it. Markets working through these walls of worry, which is what I meant when I said how the market reacts to news is very informative as to the health of the patient. So far, it looks okay, but we're tactical. And we will focus on the leadership, as mentioned before, and we'll adjust and change if we need to. And we'll play defense like we did in the Great Financial Crisis by raising cash if we need to do that. For now, things are looking good, and we will continue on the path and on the leadership themes that we have seen. And for now, thank you very much for joining us.